Protective asset protection will provide tools to make added protection more attractive and empower your business. Together, we'll help more people gain the sense of security they deserve, because we're all protectors.
Welcome to Daily Drive for Monday, May 5th, 2025. I'm Jamie Butters, Executive Editor of Automotive News in Detroit.
And I'm Kellen Walker in Las Vegas. Today on the show, GM names a new chief for North America. Jaguar restarts shipments to the U.S. after its tariff pause. And VW halts U.S. sales of its ID Buzz. Plus, Jeff Lick of Stevens joins the show to talk about the state of the retail side of the auto industry amid tariffs and shifting economic outlooks.
As inventory starts to diminish, you're all of a sudden going to have tariffed inventory, and that's where you're going to have to see the decisions of, do you raise prices, how much can you raise prices, and what that does to demand.
Let's run through all the news you need to know to keep up in the auto industry.
General Motors has appointed Duncan Aldred as president of North America. Aldred is the former head of Buick GMC, who most recently oversaw the automaker's commercial growth strategies. GM says Aldred's appointment is effective immediately. He will report to Rory Harvey, GM's president of global markets. Aldred takes on day-to-day oversight of North America, GM's largest and most profitable region. Harvey had led those operations since the abrupt departure of Marisa West last year.
Jaguar Land Rover has resumed shipments of vehicles to the U.S. after pausing them following President Trump's tariffs. The UK company had put shipments of its cars on hold in early April as it looked at ways to address the new trading terms. JLR is owned by India's Tata Motors. Shipments normally take around 3 weeks to arrive in the U.S. That means the first vehicles would reach American ports in the second half of the month.
Volkswagen Group of America has issued a pair of stop sale orders on the ID Buzz electric minivan stemming from two unrelated recalls. The stop sale orders come just months after the vehicle went on sale in the U.S. after multiple delays. Under the first recall, the brake system warning light on the instrument panel may display an incorrect symbol and color. The other involves third-row seating that is too wide for two passengers. According to NHTSA, the ID Buzz is therefore not compliant with two Federal Motor Vehicle Safety Standard requirements. Each recall covers 5,637 vans in the U.S. and 771 in Canada. As of May 2nd, VW said it was not aware of any injuries or crashes related to either recall.
And less than a year after taking the wheel at Polestar North America, Anders Gustafsson is leaving the electric car maker on May 11th. Rick Bryant will take the top job overseeing the U.S. and Canada markets. He's currently Polestar North America's operations chief and a Volvo Cars veteran. Bryant has more than 3 decades of automotive industry experience, including stints at BMW, Buick, and Honda. Gustafsson spent nearly 15 years at Volvo Cars. In a social media post, he said he will begin at a large U.S.-listed company on May 12th. He hinted the new gig is in the automotive retail business. And those are today's headlines. So, Jamie, what are your thoughts on Duncan Aldred taking over as GM's president of North America? Is he a good fit for taking over General Motors' most profitable region?
It's a big job. It's a tough job. It seems like a reasonable choice. Aldred did good work with Buick GMC, kind of setting up the strong sales that Buick is enjoying now. And, he's a Automotive News rising star and Automotive News former all-star as well. So, he has kind of has our endorsement, I guess. The thing about this role, it's really the best way to prepare someone for a CEO type position. As we said, it's like 90% of GM's business is here in North America. You're looking at the factories and the sales and dealer relations and marketing overall, even some product development. It's a really big job. And, wish him the best of luck.
Good stuff. Coming up, Jeff Lick of Stevens talks about how tariffs are affecting the retail business. That's next on Daily Drive.
Yeah, my name's Jeremy Beaver. I'm at the Del Grand Dealer Group CEO. We have 17 brands in the heart of Silicon Valley, San Francisco, 1,100 team members selling over 28,000 cars a year. Protective has been a partner of DGDG for a long time, and we are just so thankful for everything they do to help us every day. I've been at DGDG for over 15 years, and we've grown as an organization from 3 stores to the 17 we have today, and Protective has been critical in that growth. Not only in the products we sell, but long-term growth strategy through data, through insights, making sure that we are performing at the absolute best every step of the way. I think when dealers are searching for insurance companies or reinsurance companies, there's obviously plenty of choices in the industry. For us, the most important piece when we chose our partner to go with Protective and have a long-term relationship was exactly that, because of the relationship they provide. A very hands-on approach to helping us grow and drive our business every single day is critical, especially in the automotive industry where it's headed, not only with our guests, but with our team, to make sure that every single day we are at level 10. We continue to lean on our partners at Protective to make sure that we are going in the right direction and that we're gonna be absolutely at our best for years to come.
Welcome back to Daily Drive. I'm Jamie Butters with Kellen Walker. While shifting U.S. trade policies are especially challenging for automakers and suppliers, they're also disrupting the auto retail business. Maybe the most noticeable shift so far is on the demand front. Consumers seem to be racing to buy vehicles before tariffs drive up sticker prices, but the import duties will also have an impact on inventory levels, competition, and the size of the overall market. Jeff Lick is Managing Director of Equity Research for the auto ecosystem at Stephens. He joins me now from his home office outside of Boston. Jeff Lick, welcome to Daily Drive.
Jamie, great to be here. Big fan of the show.
We're so glad to have you. It's been, an interesting earnings season. Everyone's trying to digest the tariff news and what's it going to mean? How did it influence the first quarter? We saw a big surge in sales at the end of the quarter. It looked like you kind of, looking at your reports, you had sort of a mixed bag, kind of down a little for Lithia and Penske, up a little for AutoNation, Asbury, and Group 1. Nothing too dramatic, but what's the big picture for dealership groups after this first quarter of 2025?
Well, first off, in the short term, the tariff news is probably the best thing that's ever happened, or a good thing for the dealers, because it's basically driven up demand a little bit and taken down inventory a little bit, which is great for GPUs. The reason that some are down is because you still have the underlying GPU mean reversion story that's in the background. So, last year GPUs might have been in the 3,800, 4,000 range, and now they were naturally coming in to that 3,000, 2,800 range. And what happened with tariffs is, instead of maybe thinking, hey, it was going to be 2,800, now it's 3,000. So yeah, it's disappointing that GPUs are down year over year, but that was largely expected, but they turned out to be better. And then the other thing that's turned out to be better is, that demand surge towards the second half of March was pretty powerful.
And the GPU is gross profit per unit sold?
Yes. Yeah. Yes. Gross profit per unit sold.
So it was a good quarter. We certainly saw strong demand, and a lot of dealers, I think, were able to back off on some promotions. But how do you see tariffs playing out in sort of for the rest of the year in the retail space?
Well, as the CEO of AutoNation put it, Mike Manley, there's going to be winners and losers. I don't think there'll be any absolute winners, but I think there'll be some relative winners, and maybe there'll be some absolute winners. But even if you just listen to General Motors' first quarter conference call last week, they highlighted, look, that 80% of their stuff is made in America. The biggest problem children or the issues with dealerships, brands will be foreign luxury brands. So that would be Audi, Range Rover, Porsche. Penske has a big exposure to Porsche. Most of the, your audience, the smaller dealers, don't have as much exposure to Porsche, but Porsche will be an issue. And then BMW and Mercedes will be a little bit of an issue as well. But then you'll see across different models and segments, there could be winners. For example, Cadillac could be a big winner here. And the majority of their product is manufactured in the U.S. It's got, GM likes to say, hey, we build, we source where we build. So, I think that as we get into Q3, you'll start to see the tariffs hit. That's the other thing that's going on right now, is that right now they're selling inventory on the ground. So Q2 still benefits from this surge of demand, and you've got non-tariffed inventory. Where things get a little dicey, and all of the public six companies highlighted this, was that you're going to see, as inventory starts to diminish, you're all of a sudden going to have tariffed inventory, and that's where you're going to have to see the decisions of, do you raise prices? How much can you raise prices, and what that does to demand.
You kind of touched on it earlier, the disadvantage for the German brands. I'm wondering if, from a dealer perspective, if you have to really evaluate manufacturers differently in a tariff environment, right? It seems like GM and Ford might become more coveted than Toyota, Honda, and Subaru.
Well, I mean, that is the point of the Trump administration's actions. They're trying to favor companies that are based in America and are made in America. So, that's, whether you agree with the tariffs or not, I mean, one way or the other, it's going to have at least a little intended effect, which is to favor the domestic produced vehicles.
Do you have a light vehicle sales estimate for the year? I'm wondering how you're adjusting that, thinking about pricing versus volume expectations.
Well, we don't make a formal estimate for the SAR. We had talked about in one of our preview notes going into the year that it, looked like, just based on the Q4 trend in different compares for 2025. For example, CDK really messed up Q2 last year, and Q3 was affected by a lot of storms, a lot of stop sales. We were thinking 16.5 to 16.7, for the year. And now the SAR is running 18, which, I always kind of chuckle at the SAR. It's the equivalent of, someone goes into a basketball game for a couple minutes and scores 4 points, and you say, well, they're scoring 20 points a game. So, you were selling at a rate of 18 million for a few weeks. My guess is, when it's all said and done, it ends up probably, in the 16s this year. But it's hard to say, because, once we start having to deal with the tariffed inventory, and you have to start making decisions, my guess is 16 is probably where it pops out, or it could, that might be as good as it gets.
So, automakers and the manufacturer suppliers and automakers, they really have this tariff issue right in the face of their operations. With dealers, it's a little more indirect, right? It's their new vehicle inventory that will eventually be more expensive. How able are they? I know AutoNation, I think, for one, has said it can really pivot to trying to earn more on service and F&I and used vehicles. Is the dealership business just more resilient for this kind of a shock?
Well, there's a difference between being resilient and seeing profits decline, right? So I wouldn't say that any dealer is actually going to lose money. Look, new unit sales are really the straw that stirs the drink, or the snowball that gets rolling down the hill, because from there you get trades from new sales. So generally, every two deals has one trade associated, or to call it, 40 to 50% of the deals have trades associated. Well, that's where your used inventory comes from. There's a fair amount of warranty work that goes in. It comes with new, that drives service and parts. So, in used is generally only 10% to 15% of the total gross profit of a dealership. Now, certain dealerships do better than that, but for the most part, public P6 dealers don't do the greatest job with used, or they're not focused on selling, non-CPO certified pre-owned vehicles. Lithia is a little. So, I think the way to think about it is, look, what's going to happen is the OEMs are going to say, okay, well, here's the new invoice price, and here's the new MSRP. And then obviously the dealers have the choice of saying, well, we don't want to take as much. And that's always going on. There's always a bit of a, back and forth between the dealers and the OEMs. They say, okay, well, we don't want to take as many, Tundras. Well, it's like, well, then look, you're not going to get it. Maybe you're not going to get as many Lexus. So there's always a little bit of horse trading that goes on, and it's going to be an interesting time to see, how all that develops.
It seems to me like the used car market should get pretty hot. If a million or so people get priced out of new cars and into used, and there's already kind of a short supply of, lightly used cars because of the COVID, It seems like prices start going up in the second half of the year and keep going for a couple more years. Am I overreacting? How do you see it playing out, and how might dealers navigate it?
You're hitting the nail right on the head. I mean, it's supply and demand. There's already a shortage of, call it 8 to 10 million cars that are coming through the pipe that, starting in 2020, 2021, those cars are, 3 to 4 years old now. So that was already happening. And now all of a sudden, if you've got a lower SAR again, that's going to create less supply. And then if new car prices go up, in theory, that prices some people out of the new vehicle market and into the used. So now you've got supply going down and demand going up. So yeah, I would think you're going to see reasonable price increases. Yeah, but look, there's going to be offsets, because if all of a sudden the used business is robust, well, that makes residuals higher, and maybe that makes leasing a more attractive alternative, and that's a way that the OEMs are able to deal with the high pricing. So, the auto industry at the retail level, it's a system. It's, and there's a lot of variables that reinforce. There's a lot of variables that balance. But your assertion, at least initially, is, yeah, used car pricing is going to go up.
Before I let you go, I want to talk at least a little about Carvana. It's kind of a mystery sometimes to us, and I think it's for a lot of our dealer audience, it's something they really watch. They're wondering if Carvana is a big threat to them. They're going to report earnings this week, and I know you have an interesting thesis on it as an investment. But I'm curious. I mean, what is the situation, and how are they performing? Have they turned the corner? Are they a profitable, healthy company, and can they thrive in a scarcity environment?
Well, first off, look, they're very profitable. They're going to make close to $2 billion in EBITDA. Carvana is a pretty simple business that people have a hard time kind of wrapping their heads around, because look, for 50, 60 years, we've always kind of thought of the auto retailing business as a dealership, right? So even CarMax, that's used only, has dealerships. What Carvana basically does is says, okay, we want to buy your car. We'll come to your driveway with a check and buy your car. You don't have to buy a car from us, but would you like to sell your car? Now, some people might want to buy a car and sell a car, and we'll bring your new used car to your driveway as well. And they make money off the spread of what you buy a car, then they have basically a kind of industrialized way of reconditioning. So they probably have $1,000 advantage on most used players in reconditioning. So they got a little bit of an advantage there. And then they sell cars. And over time, they've built out a logistics network. So they're probably within 50 to 100 miles of virtually everybody in the US. And they've now got density. So they're making about $3,500 a car. That's the spread. That's the difference between what they buy it from somebody, they recondition it, they've got to deliver it to you, and what they sell it for. So, Carvana really makes money off the spread. It's a pretty simple business. There's, the used car industry market is, call it 40 million units, 35 million units. There's, maybe certain parts they don't play in. They don't play in certified pre-owned. And it's just, okay, well, what's the spread between what they buy the car and what they sell it for? And, they've really created a liquid market for, buying used cars. And you can see that in the auction data. You can see it with the dealers. It's, they have a harder time getting trades. Most people go into a dealership armed with a Carvana offer. So, and a lot of times Carvana offers better simply because they're selling based off of a national demand pool. So the car dealership in Ann Arbor, Michigan, their used market might only be the people that are within 50 miles of Ann Arbor, whereas Carvana's used market is effectively the entire nation. So it's a simple business, and that's why they're doing so well.
So regarding Carvana, you had an interesting observation about sort of who their investors are and what that might tell us about what's going to happen with the stock going forward.
Well, I mean, look, Carvana is kind of came out of nowhere to some degree. I mean, it didn't come out of nowhere in terms of a certain cadre of the institutional investing audience, but when COVID hit, it popped up, and all of a sudden, it was a stock that went from call it $10 to $376, and then went back down to $3. All for pretty understandable, explainable reasons. And generally, in the way it works with the public stocks is when something's that volatile that quickly, it causes the larger institutions maybe to step back a little bit and just kind of see what happens. And Carvana's been putting up some pretty solid results, very consistent metrics, almost to the extent that some of them are so good that they're almost unbelievable, which in the short term makes people a little hesitant of, well, geez, just how are they doing it? But they keep doing it, and now all of a sudden, people have gone on a lot of tours, and they've done a lot of their IR effort is outstanding, and they're very transparent. So, and it is a pretty simple business once you look at the cash flows. I mean, it's they sell a car, they buy a car first. Then they sell a car. They have a financing contract that converts pretty quick because they don't hold the financing contract. So anyway, to answer your question, what's happening now is that the larger institutional audience is starting to notice, and those are the type of shareholders that hold stocks for 5 to 10 years. And we tend to think that over time you'll get a good kind of shareholder base that holds shares, and eventually Carvana becomes a little less volatile, we think.
Jeff Lick is an equity analyst at Stephens. Thank you so much for joining me today on Daily Drive.
Awesome to be here, Jamie.
That's Daily Drive for today. I'm Jamie Butters.
And I'm Kellen Walker. Thanks to Automotive News executive producer Jake Neer, as well as our own Lindsay Van Hully, Jack Walsworth, and Urvash Kakaria for their reporting for today's podcast. You can get the latest news on tariffs, executive changes, and everything happening in the auto industry at autonews.com.
Come back tomorrow for my conversation with Toyota North America's Michael Tripp and Burrell Communications' Corey Seaton about a new ad campaign targeting young black men.
We're all about respect for people and inclusivity, regardless of what's going on in the political landscape.
We'd love to hear from you. Let us know what you think of the show and the topics we covered today. Send us an email at dailydrive@autonews.com or leave us a voicemail at 313-444-2774. And if you enjoy the podcast, remember to like, leave a review, and subscribe so you never miss an episode.